Yeah, so Feb saw a rotation in markets. We saw some pressure come out of equity markets, so there was some negative outcomes, certainly domestically, and that's somewhat on the expectation of the uncertainty of what's going on geopolitically and politically coming out of the US, where there's different announcements depending on which morning you wake up. From a reporting perspective, in the period, so that there's a good review across companies and assessment of how they've been performing. Cost control and selective acquisitions were a couple of the key messages, and uncertainty generally as well. And through the month, we saw a reasonable rotation happen through the markets. So the technology sector, which has been quite a strong leader in markets, both here and overseas, more so overseas, we've seen a rotation into a bit more of a quality focus and a bit more of a defensive focus. Notwithstanding that, valuations also are coming to the fore as well. And that's one where we've seen companies that have had or been experiencing really good share price growth, where fundamentals aren't really keeping up. Markets are starting to review that and consider what the outlook is for those businesses. Do they have as strong a earnings outlook as what we're expecting, as what's priced in? And we're starting to see a rotation out of some of those expensive businesses. That's happening in the US, it's happening a little bit here. You have a look at the banking sector here, Commonwealth Bank and the other banks had been priced for quite a rosy outlook, and now we've had the reporting update, and the margins for those businesses aren't as robust as what the market was expecting. And on that basis, there's been a bit of a pullback in some of those share prices. The market's not really willing to pay the earnings profile or the earnings prices that those companies were trading at, and so that's sort of instigated some of that rotation. For the first time in 3 years, the RBA made a decision to cut rates. Great for mortgage holders, which hopefully most banks have pushed through pretty quickly. I think given the telegraphing or the amount that they've been likely, or how much they've been pushing that forward, that it was likely to happen, that the banks would have been prepared for that, and it is priced in fixed interest markets, the expectation of rate cuts. It's the first. I think some of the analysts are now suggesting that it may be a pause for a period. There are still economic forecasts and forecasters out there suggesting we'll see further rate cuts through this year. Now, clearly, as we've been saying, that'll all be data dependent. So watching unemployment and watching inflation, so the two key points for the RBA to be focused on. If both of those still head in the right direction, so unemployment rises, so the economy here slows, or inflation continues to abate, then they'll continue to potentially reduce rates. Maybe a bit of a pause now while we sort of go through that election cycle as well, though that I think the RBA still likes to be seen to be independent and making decisions based on data. In terms of what the committee is doing, generally we have a pretty broad philosophy to begin with around getting exposure to a range of different return drivers. So whether that be cash or short-term fixed interest, whether that be long-term fixed interest and long-term fixed interest benefits when markets pull back, like we've seen in this month. Being broad across international and domestic markets, so being exposed to some of the big companies, being exposed to some of the emerging companies, being exposed to some of the small and mid-cap companies as well. So there's all sorts of different things that drive markets. Behaviours are one of those. That's one thing that we try to avoid making decisions on, is the whims and cycles of the markets that drive behaviours. We'd rather watch fundamentals and be mindful of what fundamentals are driving markets, maintain a broad diversification across what's going on in markets so that we can participate in generally long-term growth drivers and long-term income drivers for portfolios. Economically, the US conditions are relatively sound, so still reasonable economic growth. Some of that's from historic government spending. but also consumption and the consumer spending profile is still relatively robust. Companies are probably bringing forward a little bit of spend as well, though, so that's a bit of a concern. So that's, company management are concerned about the uncertainty of tariffs and what it's likely to impact them in terms of increasing costs if they're importing from the likes of China or Mexico or Canada for the US. And so it looks like there's a little bit of front-ending or bringing forward of orders, which means that there may be some increased inventories for some of those companies in anticipation of trying to avoid some of the tariffs. That's a bit of a concern because if they overstock and they bring in too much goods or bring forward too much, that they may sort of preempt or get ahead of what the demand profile may be. So that's something to watch. It's something that may be a little bit of a risk for markets as we sort of move forward to the latter part of this year. From a currency perspective, the Australian dollar has been weak. So I think it's sort of floated between the 63 to 61 cent US mark. It's been a bit stronger on the trade weighted basis, which is a bit more aligned to Japan and Chinese currencies for us, given the trading relationships and the exports of what we generate and the demand for those exports. But notwithstanding that, with the tariff talk and with the sort of US first talk coming out from the US dollar has strengthened generally around the world, and that's meant the Australian currency has been weaker. That's not been positive for markets that have been hedged or investors that have been hedged. For those that have been unhedged, it's been a bit more positive, but that's starting to change now as well. So the interest rate differential with cash rates reducing is probably seen as a bit of a driver to weaken the currency. Now that first step is out of the way and there's probably a little bit more clarity around the likely tariff impacts from the States, that may stabilise and you might find that there might be a bit of strength coming back into the Australian dollar on the back of a bit more certainty coming in to currency markets. There'll be more announcements on cash rates as we get to the latter part of the month. Inflation will continue to be watched very closely. Tariffs, clearly, in the States will continue to be watched very closely. Other geopolitical issues will be very closely watched as well. There's a lot of noise on that at the moment. Again, I think that sort of drives into the fundamentals of what we're trying to do in portfolios is maintain a high degree of diversification. So not just one market that's driving us, not just one sector that's driving us. There's a broad sector and broad market exposure across the portfolios that we're running and managing for clients to drive returns over the medium to longer term.